now we are going to study, I take the same case company, Kone, and you can see that we have the consolidated cash flows. Okay, if you see the titles of cash flow, you'll see that the three components, I don't know why they have the first one, but to me, the first part of cash flow is cash flow from operations. Your operations generate cash. Operations mean your almost daily operations generate some cash. You sell something, the cash comes in, people pay you at the till point, and you pay money to your supplier, and so on and so forth. The second component of cash flow is cash flow from investing activities. Don't you invest? You do invest. You buy some new plant, you buy some new equipment, you buy some new copyrights, R&D, and these kind of things, which are going to last. So the second component is your cash investing, a cash flow from investing activities. And generally, when you invest, is it cash inflow or cash outflow? What do you expect? In the normal situation, when you invest, is it a cash outflow or cash inflow? Outflow. So you can see that most of the cash items here from investing, they are carrying a sign, negative sign, which means going out. And if you look at the cash flow from operating activities, you see that the cash, most of them are positive, because it means from operation, you sell something and the cash comes in. So from operations, if a company is having the negative cash flows, it's not a good sign. And I would say that if from investing, the cash flow is positive sign, even that is not a good sign. It means what? You have started selling your business, basically. Do you get my point? Because cash flow from investing means you are expanding. You're buying new property. So that money is a welcome outflow, good outflow. Okay, but if cash flow from operation is negative, it means you are not able to recover your cost. Your business is not progressing. So cash flow from operations in an ideal world should be positive. But on the contrary, if you have a positive cash flow from investing, it means that you are not spending money. In fact, you are selling your assets. Come on, why are you selling them? Maybe you don't see the light in the tunnel. Maybe you see that the days are getting gloomy. You know, the doomsday is ahead. We will not be able to carry on. The business is not sustainable. So sell it. Sell the business. And you can see here that when you see here cash, capital expenditure, maybe you bought some piece of land or plant, the sign is minus 113.6. And when you see that, proceed from sale of some fixed assets. Now, this is positive, yeah? But this is not a very good positive. You know, some assets were lying and you sold it, okay? So proceed from sale of business. Oh, that's even more dangerous. You have sold some business. That is why all the cash is not good. You can have more cash by selling your business. I can imagine that maybe this business is not even wanted by Kone. Maybe it's a burdensome business. It doesn't fit into your product portfolio. Or this business, the demand is not having very positive. The consumers are not happy to buy products from this business. You sell it. Good riddance. Okay? But if you start selling businesses and keep accumulating cash, and then say, look, we are so cash rich. No, you are not. You may be, but the business will not last any longer, because then what would you do? Your factory, no assets, no machine. What would you do with them? And then cash from financing activities. Okay. Financing means money comes in. Do you know that? Financing, money comes in. Investing, money goes out. And here you can see that There are some positive things. For example, change in deposits and loan receivables. Your deposits and people who would pay you has gone up. Changes in the current creditors, minus 12.8. It means what? You have paid to your creditors. It's a good and the bad news at the same time. When you pay to your creditors, your liabilities goes down, isn't it? Who are your creditors? People who you owe to. Who you owe to, for example, supplier. Okay. So when you buy something on credit, you haven't paid, these people are your liability, yeah? But when you pay them, what happens? Your liability goes down, but so does your cash. I'm your employee, you haven't paid me salary for last month. This month, you pay me double salary because for the last month and this month, yeah? Your liability has gone down, isn't it? But your bank balance is also down. Okay? So it means that the company, because it has paid its previous creditors, so the liability has gone down, but the end story is that cash is going. So basically in cash flow, you don't become very moralist. Anything which brings cash in is with a plus sign, and anything which leads cash out is negative thing. Simple. But these kind of moralistic things, which we see more in the income statement. Okay? Then comes, who's doing increase in equity, 23.1. Increase in equity. That goes to this gentleman's point that can they increase their equity? Yeah. There's a fresh shares, 23.1 million last year. So money comes in. When you issue shares, what happens? Money comes to the company. That's why the sign is 23.1 plus. Yeah. And then comes payment of long-term liability. So the money goes out. And what is 849.2? Profit distribution. Yes, profit distribution. First of all, what is profit distribution and why the sign is negative? I want you to answer this. Profit distribution, first of all, please tell me what is profit distribution? And secondly, why the sign is negative? And I can give you a hint that I'm not surprised. It's normal. I come back to this change in non-controlling interest. It's minus 3.1. It means money go out of the company. That's for sure. Yeah. But it's very, very important for you to know who are these non-controlling shareholders. Okay. You want to say something? Yeah. Go ahead. I try to revise my example. Do you know that my old-fashioned example that I want to start a company, half of you give me loan and half of you are my shareholders, right? Now imagine there is a third row in the middle who say that, hey, the one extreme is that we only give you debt. Your company succeed or fail, we get our fixed rate of interest. And then this group of people say that, you know what, our deal with you is that we want to share your profits and we want to control the company. We want to control the company with our voting rights. And in turn, what we get? The profits. But there's one more group of people in the middle. They say that, Shab, could we be the middle path, something that we don't use the voting rights, we give up our voting rights. But at the same time, when we are in the queue to get the profits, which you will give to these people, we would be standing in front of them. So they are some shareholders who are not, first of all, they are not debt holders. They are completely different. Among the shareholders, there is a minority of shareholders who say that, Shab, we give up our voting rights. We don't care about votes. But what we want in compensation, that When the time comes to give the profits, share the profits, right? Like here, for example, like this one, we would be standing in the queue first. These kind of hybrid shareholders or the hybrid shares are called non-controlling shares. Therefore, one lesson we learned that not all the shares have the equal power. Some shares have the voting powers, but some don't have the voting powers. Those who don't have the voting powers, they are compensated by giving them the profits first before it goes to the ordinary. We use the word ordinary shareholder or ordinary share. And those people who are in the middle, we call them non-controlling shareholders, but the other more respectful word is preferential shareholders or preferred shareholders. You know the word preferred, preference, yeah? They get the preference when distributing profits among them. So why they get this preference? Are they good looking? No, they may be. They get this preference because they give up their voting rights. Actually, there can be a bit more profit, little bit more profit. Exactly, yeah. But you know what? Voting rights are very important. Normally, why would you not be interested in having the votes? Because you want to stick with the company for a short time. But those people who want to make a long-term plan with the company, they really want to have the votes. And especially if they invest huge money. Can you ask the Finnish government to convert its shares to preference shares? Because Finnish government is very strong shareholders in top companies in Finland. Look at Finnair shares. The government is a big investor. They have a long-term stakes with the company. Okay, they don't care about more profits. What they care about is control the company. Control, because the company is very strategic from national point of view. It's a symbol of the nation, basically. It's a big company. So therefore, they will never ask for non-controlling shares. But if there's some people who are like short-term, spending very less money, small investors, they may choose for. And generally, I can tell you a rule of thumb, their percentage is very, very small, maybe 2, 3, 4%. The percentage is very low. Normally, investors want to be either extremely risk haters and only lend to the company, or they want to have certain risk appetite and want to invest in proper shares where they can use the voting rights as well. So very tiny minority is one who go for preferred shares. Somebody raised hand. Kone got cash from customers, 9 billion last year or previous year. Then the cash paid to supplier and employee. These are the biggest costs, supplier and employees. And then comes cash flow from operations before financial. Yeah, that's you can. And then you have some interest received. If it comes in, it's plus interest paid goes out, dividend received, and capital repayments. Dividend received. Kone has invested in, for example, Finnair, and the Finnair is distributing its profits. Then Kone will get this money. Okay. Companies also invest in the other companies. So the dividend comes in 8.9. Then other financing items, okay, it's negative. Income tax paid. Of course, when you pay income tax, the money goes out, sign is negative, simple. And then cash flow from operating activities is this, and then capital expenditure, maybe you buy some new plant equipment, and that I explained already. So this is cash flow. So it's very important for you to know that cash is not the profit, first of all. They are different phenomenon. And There are three components of cash which the company deals with. Cash from operations. Ideally, cash from operations should be positive, plus. Cash, second component is cash from investing. Investing is an expenditure. Ideally, the sign of a expanding business or a progressing business is that cash from investing is negative. Okay? And cash from financing could be plus minus, depends upon whether the shareholders are giving to you money or you are giving back to them. Like, for example, some years ago, Apple made a confession that thanks shareholders, you have been putting your money in the company. But I think the stage has come when I must admit, the company says that I must admit that we are no longer so growth-oriented company. Don't expect the exponential growth rate from us. And in fact, we have more money than we require. So thanks, but no thanks. We are going to give money back to you. And you know how much money they kept aside to pay back to the shareholders? $2 billion US. In how many years? In 4 years. It means when actually Apple is buying its shares back from shareholders, Apple would pay. The money would be out. This 2 billion would be with a minus sign. Okay? But if Apple needs more money, it can ask shareholders to put more money in the company or can borrow from the debt holders. So cash flow from financing, sign, you can't make a conclusion really. You can be a great expanding company, you need more cash, you need more money, ask for more equity, or you have done a lot of success and you have huge bank balance, and then you pay back to the, so there's no really, it could be plus minus sign. It doesn't really depend upon if you are very successful or unsuccessful company. But normally, cash flow from operations for a normal successful company should be positive, and cash flow from investing for an expanding business should be negative. Whereas cash flow from financing could be both positive, negative, depends upon interpretation, how you draw the conclusion. Okay. For example, when Apple was not paying dividend, then Apple said, okay, we buy back shares and we buy it with a lot of premium. Yeah. Investors happy. Okay. So that's something about the cash flow statement. Mari, you have a point to discuss? Kone, yeah? Did somebody offer? They offer to buy something. To buy. All right. 17 billion.
And how can it go?
Well, it would be first of all investing. Okay. And it'll be with a minus sign because they pay. Mm-hmm. Yeah. And again, see, look, Mari, it's not simple. Imagine they choose to buy 17 billion, yeah, with the company. And now this gentleman's point is very valid. They want to buy a company with 17 billion and they say, hey, we pay you 10 billion cash, but 7 billion shares. So in that case, even though the company is 17 billion worth, yeah, cash outflow is 10 billion. Because share is not counting in the cash, is not counted in the cash flow. We only count the cash, the hard cash, cash or cash equivalents, as you said, that the liquid, like the, for example, the cashable assets. So yeah. Mm-hmm. Okay, I asked you this question. If Kone is offering which company? Kone Group in 17 billion. 17 billion. Now I ask you something. Imagine Kone buys this company for 17 billion cash paid 10 billion, shares given 7 billion. What would change? How would you record? How the records of the company would change? So I can write it here. Kone is successful in buying, what's the name of this company? How you spell it? TH? Germany for 17 billion euros, cash paid 10 billion, and shares given, shares of Kone given for 7 billion. Yeah. What happens in the Kone financial So imagine, I read out, let me see if it is being shared. Yeah. Imagine Kone is successful in buying Houston, Germany, this company for 17 billion euros. Kone, the agreement is that when this acquisition takes place or the merger takes place, is that cash paid would be 10 billion euros, whereas the shares of Kone would be given to them for 7 billion euros. What happens in the financial statements? And the financial statements are, can somebody tell me which three financial statements we talk about? The first one is then in this course, I'm only talking about the statements used for this course. Balance sheet and cash flow. What happens, where happens, what not happens? Yeah.
Is this a buyout or a merger?
I'm finding over at the moment.
Are they just consuming the company and that's it, or are they just merging them?
Yeah, good question. You raised very important term. The buyout can be of two types. It could be a merger or it could be an acquisition. When you acquire a company, look at the word acquisition. Can you see something like predatory behavior? You know, you buy and you acquire something, you conquer something. Yeah. So normally the acquisition is more unfriendly. Merger is more friendly. Merger is more friendly. The company agree that, hey, you know what? I think we should merge. Yeah. Generally, the acquisition is by a big company to a small company. You know, the Darwinian law. Merger is more of the equals. The company, for example, AOL and Time Warner was a merger. AOL was a massive company, Time Warner was a big company, and then say, all right, let's merge and make it AOL Time Warner. Yeah? Make sense? Whereas the acquisition is more like an angry bird, like there is a company trying to hide it, and then somebody, hawk, is coming and kind of preying the victim. So that's more like a kind of aggressiveness. Okay. But one more piece of news. When you read in the financial media, actually many mergers are acquisitions. But normally the financial media is told not to use the word acquisition because that may send the wrong vibes. And many times the company who's the acquirer, the company who is acquirer, the buying company, tell the financial media that, hey, please don't use the word acquisition. It will dent our reputation, because then companies will be scared to deal with us. They will not be very happy to do business with us because they would be scared that one day we will acquire them. So use the word mergers, friendly merger. Mm-hmm.
Even though Kone is a smaller company.
Yeah, it's possible. It's possible.
How often is it?
You can have a leverage buyout. You can borrow and do it. Yeah, leverage buyout is possible, but it's awfully dangerous. Very often it hits you back. Yeah. But my point is something at this moment is that I just give this example because Murray shared this case in the context of Kone. So the thing is that, how would you record it? I want you to make mistakes now, but not in the exam. Do it. Normally,
Because they can afford their chips.
there's one investor who owns 51%. And even though you own 49%, it makes no difference. They will always win. But normally it happens that even the small companies, there's not only two polls. There are some small shareholders. And when two or three big powers among the shareholders try to win, then the small shareholders become very important. Like, for example, if there are 3 or 4 major political parties, and elections are going on, and there's a neck-to-neck fight, and it's just a matter of 1 or 2 votes, then the role of minority shareholders becomes very important. The same happens in the
There's a show called Silicon Valley, in which all of this is very, very useful. I'm also very good.
Yeah, very nice.
And a simple question. So the 7 billion euros that Kone gives us shares, it goes to the balance sheet. Where does it go in there? Is it liabilities or?
It depends how Kone does. Kone can raise more equity from the shareholders, or the Kone can give its reserve equity to the German company. There's always some equity lying with the company which is not in the market. So they give, so it means it goes out of the company.
Also, since I'm thinking finance, I'm thinking about portfolio management mainly. When do we, how early do we think about the thesis topic?
It depends how you start, but I hope it's not just. So what I suggest you that you
I have a few topics already.
You can book a meeting with me and we can talk. Not next week, I would be in Paris, but the week following, if you drop me an email,
that works.
someday, then we can discuss. Yeah. There is a course called Financial Management.
Yeah, I'll pick it up on Wednesday.
Very good. Very good.
Yes.
You can.
Share capital. Ja sitten
I think
चाहिए?
नहीं मैं ले आऊंगी।
अच्छा